Hello and welcome to Jazz After Dark. How you guys doing out there? Hope all is good with you. It's been a while, huh? We had a conference that we went to last week. It was okay. Probably not something we would do again. Tonight, joining you with Chattanooga Whiskey. This is a special request from Charlie, actually. He's spent some time in Chattanooga, and he said, you got to try it, man. It's not bad. So Chattanooga Whiskey made straight from the hills of Chattanooga. We'll see how it goes. And I got this silly glass again with this little finger notch. Who's going to say it? Like, which one of you is going to leave that comment? Like, I don't know what's going on with this notch. Come on, man. Y'all don't see me at nighttime chilling outside in this beautiful Florida weather. All right, doesn't smell amazing. Chattanooga Whiskey. Oh, it's sweeter than I would have thought. Ain't bad. That ain't bad. Hey, that would probably grow on you, actually, the more you let it bounce its flavor profile off of your palate. Hey, I like hanging out here with you guys. This is a little different than our, sort of faster videos that we do. And tonight is going to be a real thinker for you options traders out there, options investors, or maybe you're retired and you use something like covered calls for retirement income. I promise you that every other advisor cannot talk about this. I don't mean that in an egotistical way. I mean, it isn't like they just don't even look at this stuff. I am fascinated by any means of income that can be driven for clients. Like, at the end of the day, my only goal is that you have the income or you hit the dollar amount that you need for your particular goal. However we got to get there, I'm going to get you there. And I realize that a lot of our clients actually trade options on the side. And I love it. I could talk about that for literally days. I love it. I love it. We actually have a handful of classes to get people up to speed on how things work. But I've mentioned numerous times now that as a form of income, maybe that selling covered calls is something you'll look at. Maybe it's consideration. If you're retired, it is certainly a consideration, especially if you have any interest in the markets. There is literally zero risk to you doing it. And as I'm going to share with you tonight, you can most likely smooth out the returns of your portfolio that's dedicated towards this more so than the stock market. So could I show, without messing with the data, I've seen people do that. It irks me right there. That puts a bad image on everybody else. But can we smooth out the returns of an otherwise index? And can we do better than it by trying to sell some covered calls with literally no risk? So keep that in mind. If you're brand new and you're like, yeah, let's see what this guy's talking about. No risk, right? You are already taking the risk that you were going to take. We're just going to add a little income on top of it. And this is not one of those whole life garbage things that they're talking about out there. All right. The first thing we're going to do. I love this, by the way. We are now sort of absorbed under the Goldman Sachs umbrella. Love them or hate them. I love the data that they provide. I think it's awesome. And so I can do wild and whacked out studies on things that really nobody else can do, that will share it with you anyways. And so the first thing I did is I said, okay, can we beat the stock market? Let's be honest about it. And I'll share all the specific data here with you in a second. What I'm going to first show you is the S&P's total return. And when I say total return, we're including dividends that were paid out. So what that means is if you're going to do a study and show somebody the total return of the S&P and benchmark it to something, you have to account for the dividends paid out. You have to methodically reinvest those dividends and assign it some point in time where you'll do that. Otherwise, you could very easily skew the data. So for this, what I did is I said S&P returns, the raw returns, then take the dividends, and I want to reinvest them on a monthly basis every single day at the beginning of the month. And if that beginning of the month is not a market open day, it's a weekend or something, then I want to go to the next available day. So it'd be really realistic, and this is more than likely what all index fund investors do anyways. You reinvest your dividends, and if the order can't go through on a Sunday, it just goes through on a Monday or Tuesday or whatever, the next day. All right, so first thing we have here. In the light blue, you've got the S&P total return factored honestly and very, very normally, right? Then what I did is I said, in their platform, they call it buy rights. It's covered call, it's the same thing. The dark blue line says, well, we've got to pick a covered call to sell. And so I just picked 10% out of the money. And I'm going to share with you all of the scenarios in a second, so hang with me. But we said, okay, what's the growth of $100? Realistically, you can't do this with $100, but we have to pick a number to start with. What's the growth if we sell always 10% out of the money calls and go 1 month out in the future? And we do this at the exact same time that we would have reinvested our dividends in the normal total return index. So the S&P over the course of almost 20 years would have grown from $100 to $636. You guys can fact check me on that if you'd like. And then the covered call strategy, just doing this repetitively and like a machine over and over again, would have yielded $708. So already we know that we can outperform the S&P, but at what cost, right? What is the volatility to be expected? When the S&P falls dramatically, will I fall more than that, right? Are my returns going to be more, how do you say it, more volatile, meaning that while the S&P is plugging along at its like 0.9% a month on average, am I going to be at like 1.1 minus 1.1, 2.1 minus 2.1? Is there this big range essentially? And I'm just trying to make it simple. I understand that there are very sort of accepted words that you use for that. I'm just not going to say them. I'm going to keep it real simple. All right. The next thing, and this was just pure curiosity, I thought, let's pretend I don't want to do the S&P. Let's pretend I'm a little more astute and I want to pick on an individual sector. Maybe because I don't believe in healthcare. I just don't want to do that one. I don't want that part of it. I don't want to do maybe consumer staples, or I don't want to do utilities. They bore me. So let's pretend that you want to do an individual sector. Well, if we look at that one, we've got the same concept here, but broken down by sector. Now you notice I didn't include communication services, which partially would have been called that, and then partially would have been called telecom, because I didn't feel like putting all that data together. Quick note, communication services, that sector of the S&P, hasn't always been like that. Prior to mid-2015, I believe, it was called the telecom sector. And you say you got to put the data together, and I was like, we can live without that, right? So if we look at the data here, growth of selling of $100 of selling 10% out of the money covered calls, about 20 years. The biggest bang for your buck in dollars would have been in tech. You guys could have probably guessed that, right? Tech is the most active. Next up comes consumer discretionary, which, remember, right about in here had some changes, and then also right here at the very end also had some changes to how they account for, or what stocks are included in that, but minor changes. You work your way down, you say, well, financials would have been a waste of your time relative to the other sectors, but no, not horrible, just wouldn't have beat the market. And so all of this performance really was helped both in the S&P and by selling covered calls. It was really helped by consumer discretionary and in the tech sector. So, okay, that's very fair. So we have no problems there. The next thing I wanted to do is say, what is the outperformance that I could get if I were, so that was dollars, now we're talking about returns. What was the outperformance I could get by sector, and what sector would be the best to outperform in terms of percentages? It's going to bore you to death. Here we go. Consumer staples. Isn't that crazy? One of the more boring sectors out there. Annualized outperformance of the S&P of 2.7%. You'd be wasting your time with some of these others in here. In other words, I'm sorry, I said the S&P. I should have said sector. So not the S&P. The selling covered calls on the consumer staples sector would have outperformed that sector by 2.7%. So in other words, where was tech? Let's go back over there, because we just talked about that. So in the tech sector, you would outperform the performance of the tech sector by 0.45%. And the numbers aren't there. I just remembered them in my head. Plus, you can kind of guess, right? So that's what I mean by that. I'm so sorry. That should have been a little more clear. But I was just curious, if one were to benchmark themselves against a sector, let's say you're only going to sell covered calls on the tech sector. Is that worth your while? Would you have been better off just investing in the tech sector? Well, I would argue that since there was a period of time where you would have had to pay commissions through that, it wouldn't have been that worthwhile. You very likely would not have had a net return of 0.45%. You'd have been better off over here, where even after commissions that you would have paid in the early 2000s, even into the mid 2000s, you'd still have a positive net number. So a bit of a sidetrack there. My apologies. Sometimes I get carried away. Okay, so then I said, okay, well, if I'm going to do this, somebody's going to beat me up, right? I know I'm going to see comments in there about every last little thing. And so I said, let's put it all together. If you're going to sell covered calls, be it for retirement income, just for fun, to prove me wrong or to try to prove me right, what's the best way to do it? Now, option traders will often focus on deltas. They will say, sell a 30 delta call, sell a 40 delta call, something like that. You will hear that term thrown around. Option investors tend to focus on a little bit longer, not a longer time frame, but they tend to focus on a little bit longer goal profile. So they're saying, I will go 1 month out, maybe 2 months, but I am not focused on what the return is over the next month. I'm focused on my return over the next 5 years, right? So they look at it that way. And because of that, they will often say, go 10% out of the money, go 15% out of the money, meaning stock price is trading at $100. They'll say, go to the $110 call in this case and sell that one, right? Instead of saying, go to the 30 delta calls or puts or whatever. So what we're going to do now, this is going to overwhelm you. Don't let this scare you. I always like to tell you that ahead of time. We're going to look at the S&P's performance with some data behind it. And then we're going to look at various option selling covered call strategies to see what would beat the market. What would be fun, maybe with some less volatility, but in exchange, less return. So you can kind of gauge where you would fit in with this. And if it scares you, I'm sorry. Sometimes I do this. It's like I need my brain to work. I can't talk about the Roth IRA all the time. It's cathartic for me. I'm sorry. All right. So, wow, that's a lot. Hang in there. So S&P, if we look back to through the same time period, almost 20 years, the average return would be 10% right on the dot. You say, well, Dustin, that doesn't make sense. How could it be 10%? They tell me 7% is what the expected return is on average for the S&P. That's usually after inflation, the numbers you're getting. The raw total returns, which I will never say that again like that, is 10%. That is what we get over the last 20 years. You could zoom out further and that number does not move very far from that. It goes into the nines a little bit, but that's about it. Okay? We have, for the geeks out there, your standard deviations of returns, your Sharpe ratio, which is a measure of your returns really based on how volatile the underlying return would have been, or is in this case. We have your average, your median. We have the biggest loss in a given month, and we have the biggest gain in a given month. I couldn't change these, I'm sorry. The way I have to pull them up is this way, so I'm just explaining. And then we have the standard deviation of those monthly returns. And then when we get into options here, we're going to talk about the average percent out of the money that you would have went, and I'll also use deltas as well. The average percentage premium that you collected relative to the stock price. And then I put the bid-ask spread in there, but let me get to that in a second. So let's start with the easiest thing here. 10% is your sort of benchmark. We got to do better than that, or if we're not doing better than that, we need a really good reason why. So if you were to sell at the money, sorry, I could not change that either. 0% out of the money is considered at the money. If you just did that going forward for 1 month, you would not outperform the market. It would have been better off for you to just simply hold on to the S&P and go for the ride. Granted, your volatility would be less, your success rate would be higher, your average and median returns there would be less, of course, and you would have a little bit less. So you would have a little bit less of a drawdown. You would, of course, have much less gains there. And you can kind of see how that plays out. Your average percent out of the money is basically 0. It's supposed to be. And you would have collected 3.1% premium, right? That's naturally going to be the higher amount because you're closer to the money, or in this case, at the money. Bid-ask spread, very tight. At the money options tend to be pretty tight. As you work your way down here, you can see that the returns improve to what we showed just a minute ago. 10% out of the money should beat the stock market with about the same type of volatility in terms of our returns, about the same total success rate relative to the volatility that we're taking on. You can skip that if you want. Average returns, median returns, of course, a little bit better. That's where we're kicking that in there. Drawdown is basically the same, so it's no different than if we would have just participated. The overall volatility on the down moves will be about the same. Our up moves, of course, are limited because we sold call in this case, so we can't participate in those monster snap, quick snap type rallies there. We've got our average out of the money call. We're shooting for 10%. By the time we do that and have to round up and down, we got an average of 9.1%. And we've collected just less than 1% in premium. Remember, the average return on the S&P is about 0.94%. Our average premium is 0.9%. And then the bid-ask spread is just a touch wider there. The reason I put this here, by the way, is so that you guys could understand that as a human, what happened? What the heck is going on these days, man? I'm just trying to do my thing here. And this is, let me see. Let me give it a chance. Aha! Thanks for hanging with me. I don't know what's going on. The reason I put that there was to show you that as a human, you could very likely do better. As a model, we have to assume that you don't take the second to realize that if it's a dollar by $1.25, we don't assume that you'll take a second and say, well, I want to sell a covered call. Let's see if I can get $1.20. Nope, I can't get it. Could I get $1.17? Bing, there it goes, right? I can't model that out. So I just say that the spread was 16% on average, and you had to deal with that. So I'm factoring in the slippage for all of you that want to beat me up about it. Okay, so then we move on to the doing the same thing, selling covered calls 1 month out, but going by deltas here. That gets a little bit more detailed. The options guys out there, you're going to love this part, but under no circumstance can you actually beat the market if you really stay with that every time. I don't know a human out there that would say I always sell a 30 delta call on the S&P on the same day every month. Yeah, you know what I mean? Just probably not going to happen. And then what we do down here is we talk about selling covered calls based on the total yield that you're collecting, meaning the premium. So if you're going to say, every time I sell a covered call, I better be able to sell it for enough where that total yield from selling, the premium collected, is 1%, average 0.9, and then, oh, well, I want 2%. In other words, you're someone that says, I believe, Dustin, that I can make 2% a month by selling covered calls and trading options. You absolutely can. That's just a function of you placing the order and being sort of mechanical about it, right? However, you would have been better off just saying, I will hold the S&P and maybe randomly sell calls when it's had an extended move or something. I can't really model that. So the moral of the story being, you're looking at that 10 to 15% out of the money. 15% is going to be a little more difficult, but generally 10% out of the money. So it's a long way, and thank you for putting up with me through the glitches there. But it's a long way of saying that if you're going to be someone who wants to generate income, investing in dividends and things is fine. But if you want to get a little bit more geeky about it, that's just on the S&P. Imagine you wouldn't do your whole portfolio just on the S&P. You might pick some different areas, maybe a different sector or something, and try to generate a little more yield. It could also be that the S&P is a little boring for a while, and that, of course, is accounted for. But maybe you as a human say, I'm going to go over to tech. Everybody's fascinated by AI right now. I'm going to be a covered call seller. I got some of those stocks in there. I'm just going to do it. The point is, at some point, you want to, like we talked about, take that second step, right? We talked about this class being something where I may not always get it right or be focused on a topic that you like, but we want to take the next step to just learn that second level. Let's not even go on to the third, fourth, and fifth level. Let's just learn that second level. Covered calls is the second level for someone who holds stock in their portfolios. All right. Yeah, that'll about do it there. I'm going to wrap it up, and thanks for hanging out with me. We'll be back, of course, tomorrow. Do it all over again, and enjoy the rest of your evening. See you.